First of all, I wanted to start off by thanking you, Professor. You are truly one of our heroes at RVW, and I mean that from the bottom of my heart. We've read almost everything you write, including your earlier books of Stocks for the Long Run. I've followed the updates and constantly been impressed by the wisdom, the quality of your thinking, and you're really set apart from the pundits and the predictors and the forecasters of Wall Street, for whom we have a profound disrespect. You're in a class of your own with a handful of others, and I mean that from the bottom of my heart, truly.
I appreciate it.
So
Thank you.
On behalf of myself, my family, who have benefited greatly by your wisdom, because we have followed largely your advice and your insights, and our many clients, we are all beneficiaries of Siegel wisdom, and for that I want to thank you most sincerely. I also want to tell you what a great honor it is for us at RVW to be able to host someone of your caliber. We try to bring to our clients the sources of some of the wisdom that we employ in the portfolios we design. We sit on the shoulders of giants, as I said, and our goal is not to invent or create any theories or algorithms for investing. It's to figure out which sockets have the high voltage output and to plug into them. And you are truly one of the high voltage outputs of wisdom, and for that we thank you. I'm going to step aside now and invite you to share with us your thoughts on where we are, the economy, the markets, maybe touching, if you can, on some global issues and emerging markets. Try to give us the five. And then hopefully we'll be back to ask questions and pry a little further into some things. But we'll hand over to you. Thank you.
Okay. Thank you very much. I'm going to give you some of my thoughts, and then we are set up for Q&A from the audience. Is that correct?
We will ask you a few questions just to moderate the professor.
Do you want me to just start 10-minute, 15-minute introduction, and then?
That would be, yes.
Yeah.
We're here to learn from you, so please share with us your thoughts and wisdom.
Let me try to give you the big picture here of what I think is important. In the middle of December, I was asked to speak at a Wisdom Tree advisor event in New York City, and it was specifically to preview 2018, this year. And I said 2018 is not going to be anywhere near as good or as easy as 2017. I said that the corporate tax cut is already priced in. And what happened in January was they decided to price it in again. They were using the same reason. It had already gone up by the percent that the corporate taxes were going to boost earnings, and then it kept on going up. What I saw in January was a very classic case of what we call trend followers, or more modern term, momentum players. They were jumping on the trend. They had their stops 2-3% below the market. Everyone had their different idea where the stop was. They rode the stops up. It was all programmed in. They ride the train until it starts going off the tracks, and then they jump. And what we saw 2 weeks ago was that jump off the tracks. I think it's a much healthier market now. A lot of those trend followers are off. Volatility has come back to much more normal levels. In fact, I still think a little too high, except for recessions. The VIX index really should be around 15, and right now we're just about 20 in the index. So there's still fear, which means there's some people buying puts to protect themselves, against some of this volatility. But we've got most of those trend followers off. So what is it going to be? It's going to be a battle between interest rates and earnings. Earnings are fantastic. There's no question about that. but interest rates are going to be a struggle. As all of us know, the price of stocks is the present discounted value of earnings, all discounted by interest rates. So I call it the struggle between the numerator and the denominator. The numerator, which is earnings, are going up. I mean, the forecasts, I think they're too high, but even if we shave them, we have operating earnings, which is a pretty conservative concept of earnings. Right now, I just looked it off of the S&P website at $154 for this year. That puts the market at around 18 times earnings on this year, which is quite reasonable in a low interest rate environment, to say the least. I'll talk a little bit about what that means for returns in a moment. Let me also say, do not follow the Atlanta Fed GDP Now indicator. I've been warning people about that for many months, that it is not a good forecaster at all. It came out 2 weeks ago with a 5% estimate for the first quarter here. I think that's now shaved down to 3 or 3.5. But let me tell you, the people that I respect that are doing the forecasting are now calling for the first quarter to be 2.1. So everyone who thought, oh, we're in the 3% world, we're not. We're not there yet. Now, all that said, first quarter has had a history of being biased downward because of seasonal adjustments. 2.1 isn't bad. We've often been in the ones in past years. So that could mean we're up to 3 by second or third quarter, but we're not there yet. Inflation is definitely a threat. When I say a threat, it's nothing to panic about. I mean, we're hitting the goal of 2% inflation. But as I've been lecturing over the last 6 months, there's no way that the U.S. economy can continue to create 150 to 200,000 jobs per month and not have the unemployment rate continuing to go down. Now, we all may argue whether it's 4.5% or 4%, at which point labor markets become so tight that wages start going up. But 3.5% has always been a point in post-war history where wages start rising. And at a rate of 150 to 200,000 jobs per month, which has been what we've been seeing over the last 8 months, that will be reached by the end of the autumn and early winter. And that's the best case scenario for holding out against wage increases. They may come much earlier, which means the Fed is in a tightening mode. Does not mean a recession's on the horizon. I do not see a flattening of the curve. First of all, we've got to get used to the fact people have voiced the worry about the flattening of the curve. The 90-day Treasury bill is now at 159. The 10-year is at 289. So we're 130 basis points of a spread. The average spread in the 1950s and 60s, similar period where we had low inflation, was about 70 basis points. So we're still at a very healthy spread. We don't have to worry about inversion. I do not see a recession this year, but I see the Fed tightening to try to slow down that job growth to a more manageable level. Hopefully, even if job growth is slowing down, that we can get a productivity boost enough to get the GDP to 3%. That's yet to be seen. As you know, productivity has been extraordinarily poor during this recovery, the poorest of any recovery in post-World War II history, for reasons we economists don't completely understand why, although regulation is certainly one of them, and hopefully a lighter touch on regulation is something that we might see as boosting that productivity going forward. Nonetheless, earnings are, as I said, we're looking S&P operating earnings of $154. Now that might be $10 too high. That's still 144. But one thing I have to warn you, I see for 2019 an early estimate of 170. Wow. The earnings, because of the corporate tax cut, are front loaded because of the expensing procedure. So don't forecast, oh my goodness, we're now in another 15% annual increase in earnings because of the corporate tax cut. No, this is a front loaded tax tax decline that increases earnings. So the earnings growth in 2019, 20, 21, 22 is going to be much, much more modest. I would say mid-single digits actually on the S&P. Still not bad. From current levels, I expect a real return on stocks to be about 5%, which is a little bit lower than the long run average of 6.5%, but still way above bonds, whose real return, as you know, going forward is less than 1%. The 10-year TIPS is selling for 77 basis points right now. So you're locked into a 77 basis points, and that's a taxable rate of above inflation. Stocks are going to be, in my opinion, at least 5% above inflation. You've got a very nice margin there. Europe is even cheaper. Emerging markets is still cheap. Do not ignore global. Global is still going to do well. Yeah, I know about emerging markets always got hit, but they're bouncing back pretty well. I'm just taking a look over here. I mean, despite the comeback. Wow, that we have that DEM, which is one of our oldest emerging market dividend weighted stocks. It has now gained back over half the loss that it suffered from January 29 through that tremendous sell-off. And by the way, emerging markets usually don't recover so really well. It's still going to be, I think, a good place. I think Europe is still basically a good place. They do have a lower PE. Part of it is because of a different mix that they have in terms of their sectors, which argue for a slightly lower PE. But you're looking at 13, 14 PEs on Europe, still looking good. Japan also very reasonable. So I think I think this is great. I think we got the fluff out of the market, the trend followers out of the market. Could they appear again? Of course. They've been part of markets for hundreds of years. It's just that things happen faster now because everything's on the computer, and we have a lot of liquidity and a lot of immediate reaction. But there's nothing different from going all the way back to other bull markets that we've seen. So I think it's a good time to place your equities. You're getting a better rate than obviously you did 2-3 weeks ago. And as I'm calling for a return averaging 5% this year, 0 to 10 is my range. Of course, in the short run, all you guys know anything can happen, and the standard deviation of 1-year returns is so high that it's actually a fool's errand to make a prediction. And as my colleagues say, Jeremy, you're one of the fools that keep on making predictions, although you're pretty good at them. So I'm offering you my advice. But as I say, when we look at the longer term, which is what I hope you investors should mostly be focused on, I see 5% and maybe even 5.5% real return on equity, with probably even slightly higher returns of 6.5% after inflation. After inflation, so you add 2% inflation, you jump it to in outside of the United States. So with that introduction, there's so many things to talk about, but I'm going to hand you guys my baton to shoot any question that you want at me, and I'll do my very best to elucidate.
Hello, can you hear me?
Yes. Yes.
Okay, great. Professor, just a question on productivity, and we may respectfully disagree with each other, or you might even take a little bit of what I've said, but our theory is, and when we talk about productivity, is we don't think that the tools currently around are capable of measuring productivity adequately. We don't think that productivity can be measured in the way that it was because of the intrusion of technology into every aspect of life. And I could give you dozens of examples, as you could probably give me. I suspect you're familiar with this argument, and I would love to hear how you feel about it.
Well, yes, and so a lot of the discussion goes around the fact that there's a lot of free goods now that weren't free, and how do you handle free goods? Is it being properly handled by the Department of Commerce? In my lectures, for 2 years, I've been saying how many people have bought an encyclopedia the last 5 years, or an atlas, or a dictionary. Those things are free now. That used to be over $100 billion reference industry, which is now zero. Yes, there are some questions about how you enter goods that are now free, that technically it can be done, but the Department of Commerce does not always do it optimally. Those economists have studied in that, say that might add 2 to 3 tenths to the productivity numbers, which would definitely make things better, but still well below average. We should have labor productivity growing over 3% a year during the recovery. In fact, it was less than 1. So at least some of the economists that have tried to make corrections for this have said, yes, there is a point there, but it isn't big enough to explain the difference. However, one also has to say that in a service-oriented world, and particularly in the area of medical services, one asks the question, how do you measure productivity in the medical field? And that is also very, very difficult to do. We also, of course, as you know, we spend far more than anyone, our country in the world on as a percent of GDP, medicine, paying much more for medicine and some other procedures, although we do get some excellent care along with that. But how do you measure productivity in the medical field is always been a challenge, and being as large as it is in GDP makes it even more troublesome. Other quality changes, such as houses having bigger square footage, automobiles having much more sophisticated, all that is taken into account by the Department of Commerce when they do their price indices and productivity data. So it does help, in my opinion. I don't know whether it's the total explanation for that, because we do measure prices of output. We have food output, we have auto output, we have brick and mortar output, and then we have information output. And information is what has become much cheaper. But information is mostly an intermediate good that feeds into, of course, other things. And it might just be a delay that we need with the technology, nanotechnology, artificial intelligence, AI, as we call it. All those factors are in their infancy that could explode on the scene and ratchet up productivity. But on the official statistics, we are yet to see that.
Okay. And then one more, and then I'm going to hand over to other members of the team. We have, as a group, tremendous difficulty with Professor Schiller's concept of the CAPE ratio.
Yes.
Unimaginably complex difficulty, giving it any credibility whatsoever. We find it to be so fundamentally flawed that we've actually had arguments with clients who, when we've said what we think about it, they've thought it was audacious of people like us to criticize a Nobel Prize.
I agree with you 100%. And I urge you to read, I urge you, I don't know if we have this article. Wisdom Tree will be happy to make it available. I published in the May-June issue of Financial analyst journal, the FAJ, which is one of the most prestigious of the finance journals, an article called "The Shore Cape Ratio: A New Look," where I go into detail of the deficiencies of the Cape ratio. I've been a critic of the Cape ratio for years and have said that it's been a false indicator of valuation for years. And I documented it in this article that is published. By the way, FAJ has told me it's one of their most downloaded articles of the last 5 years. And one of my basic arguments is that in 1997, 98, the Financial Accounting Standard Board changed the definition of earnings to mark-to-market, which caused tremendous declines of marked-down assets in recessions, and particularly in the financial crisis. And since Bob Shore uses a simple 10-year average of earnings in his denominator of the Cape ratio, he's got a couple zeros in there. They don't drop out until 10 years after the financial crisis, 27. Well, we're almost there. 2018, 19, 20. Then they'll drop out, and that tremendously elevated Cape ratio will go way down. And I document what happened. So we're getting a distorted Cape ratio. I've talked about why it's not accurate, and it has not been accurate. In fact, it has, over the last 10 years, been one of the worst performing indexes ever, forecasting tools of the financial market. Thank you.
Great. This is Stefan. So I actually read your article, A New Look, on the FAJ. It was a great article, so thank you for that. And I was also wondering, what is the thinking behind index construction that uses factors such as dividends or revenue other than market cap, like the S&P 500, for example?
Well, we engineered, we were one of the first to engineer what's called fundamentally weighted indexing, where the weights in your portfolio are based on fundamentals, either earnings or dividends. Now, you can use others, and others have used other factors, but those are the two factors that we used. And it's not just market cap, because market cap gets distorted by people running after hot stocks and become overvalued. I was very attracted to the fundamentally weighted arguments after the tech bubble of 2000, where I warned, I said, stay in stocks, but get out of tech. At that time, it was very hard to do that. With a fundamentally weighted index, you are not overweighted in the bubble sectors. And that was the fundamental concept between to shift away from market cap weighting, which takes no account of earnings or fundamentals, into fundamentally weighted, which also makes no forecast. We're not trying to forecast earnings or pick companies or sectors. We're just saying that their weights in your portfolio should be related to either earnings or dividends. And, our historical testing has proved those to be superior indexes for long-term investors.
Great. And you also briefly mentioned this, but how do you feel about including foreign markets in portfolios, and where do you see the biggest risks versus the biggest potential?
I've always been an enthusiast of foreign. It's going to wax and wane. As we know, there's periods, and as the Dow is very strong, that it's going to be tough to do international. When Dow is weak, it becomes easy. But in the long run, over half the world's capital is outside the United States, just over half. And it doesn't make sense to only take companies that are headquartered in the United States, because there's other companies in the world that sell billions of dollars to the United States that might be headquartered in the UK or Germany or France or many, many other countries. This whole diversification just by where you are headquartered always didn't make sense to me. It should be on the basis of industry, on the basis of other fundamental factors. And if you take a look at those fundamental factors, as I say, emerging markets are extremely attractive still. I'm not going to pick, I'm not one of those that pick any particular one. I'm not a person that picks individual sectors or individual countries. But I do think that both Europe and emerging markets and even Japan should definitely be. I mean, I would say right now, you should have half your capital outside the U.S. I overweight my own personal portfolio is still overweight in emerging markets because I thought that those in early 2016 got sold down to way too cheap levels that I had just never seen. Probably have to go back to the 97 financial crisis to see anything as cheap as that. So I went way overweight at that particular point, and I still think that they're buys. So don't ignore global, certainly for construction of your longer term portfolio.
Perfect. Professor, I wanted to ask you one more question. You know, we're all CPAs at RVW, uniquely, I think. We look at things from a CPA's perspective as well as being in all the other necessary qualifications. Can you comment on the fact, and we believe this, I'm interested in your input, that the quality of US earnings after Sarbanes-Oxley and after Dodd-Frank are superior quality to the earnings of many countries overseas, and therefore one would expect a pricier model for US banks, for example, US companies that are adhering to far more rigid banking and financial and oversight requirements, and the obligations on CPAs and officers and directors after Sarbanes-Oxley and the large capital requirements after Dodd-Frank create a situation where we think the quality of US earnings is higher than comparable earnings and therefore ought to be priced accordingly. How do you react to that?
I think there's truth to that. You know, one of the reasons when we did emerging markets and our first one, we did a dividend weighted, is it was sort of show me the money. You could say whatever your earnings are, but you know, do you have the cash to pay it out as dividend? Then we'll put you in our index. So that's a way of sort of verifying that there is cash behind those earnings. One should also say that you know, in the United States there is firm reported earnings that are not the GAAP and not what's called strict, for instance, S&P operating earnings, which are a much more conservative way of looking on earnings, stripping out stock option expenses, stripping out pension values changes, all sorts of other things that many firms are, even in the U.S., I think a little too liberal. I don't even think even the in their firm reported earnings. Now, this is not true of GAAP earnings, of course, but not even all the tech companies subtract stock option expense, which I think should be subtracted. So I like the concept of S&P operating is a very conservative concept. It's a little bit, you know, it's a few dollars less in aggregate than the firm reported earnings. I think GAAP earnings, though, with mark to market are too strict. Now, I don't think they give a good idea of the ongoing cash flow. But going to your other point of, you know, is the quality of earnings better in the U.S. than it is abroad? I mean, Europe has pretty good standards. Also, emerging markets you could question. That's why we like dividend weighted, because it's based on the actual cash that is presented. But yeah, that definitely can be one factor.
Okay, great. What I'm going to do, Professor, is you have a busy schedule. We're honestly, sincerely grateful for your time. We hope you'll share some time again next time. We really benefited greatly, and as I said, we're great fans of you and your team. I also wanted to specifically thank Lance and your right-hand man, Jeremy Schwartz, two people with whom we're very close and have given us valuable input and support. We love your Wisdom Tree group of funds, and try wherever possible to include them in our portfolios. And so we're definitely aligned with your thinking and very, very reassured by all of your comments. Thank you very much, really, from the bottom of my heart. And
thank you. It's been a wonderful conference call. I really enjoyed talking to you, and certainly maybe later in the year we'll have an update of all these issues.
I'd love it. So would we all. Thank you so much. All the best.
Bye-bye.
Thank you, Professor. Thank you, Lance.